Ladies and gentlemen, it's 5:23 a.m. on December 31st, 2025, and I couldn't sleep. The reason is simply I just got off a 2-hour phone call with my accountant. What he showed me was so disturbing, so predatory, that I felt compelled to record this immediately. Because if you're holding physical silver, there's a massive tax trap waiting for you, and almost nobody is talking about it. Here's what the silver YouTubers, precious metal dealers, and buy silver now promoters leave out. When you finally sell your silver and take those profits everyone promises, you don't pay normal capital gains tax, you don't pay 15%, you don't pay 20%, you pay 28%. Physical silver is classified by the IRS as a collectible, the same category as art, antiques, and baseball cards. And depending on where you live, your total tax burden can exceed 40%. Let that sink in. If you bought silver at $20 and sell it at $150, you might think you made $130 per ounce. In reality, after federal and state taxes, you may only keep $75 to $80. The government takes the rest. That's the tax trap, and it quietly destroys returns. Here's why it happens. Stocks, ETFs, and most investments held long-term are taxed at favorable capital gains rates, usually 15% for most people. Physical silver is different. No matter how long you hold it, gains are taxed at up to 28% federally. Then you add state income tax. If you live in Texas or Florida, you pay 28%. If you live in California or New York, your combined rate can reach 38% to 42%. Same investment, same silver, completely different outcome.
Oh.
Now let me warn you about the biggest mistake people make. Many believe that if they sell silver for cash or sell to a local dealer, the IRS won't know. That is dangerously wrong. Every sale of physical silver is taxable, no matter how you're paid. Cash, check, crypto, it doesn't matter. Dealers are required to report certain transactions using Form 1099-B, and if the IRS receives that form and you don't report the sale, you will be flagged. The penalties are brutal. Failure to report can trigger a 20% penalty on unpaid tax, plus interest. If the IRS believes it was intentional, the consequences can be far worse. Another major mistake is not keeping records. If you can't prove what you paid for your silver, the IRS can assume your cost basis is zero and tax the entire sale. No receipts means maximum damage. Now let's talk about solutions, legal ones. The most powerful strategy is the self-directed IRA. This allows you to own physical silver inside a retirement account. When silver rises and you sell inside the IRA, you pay no tax at the time of sale. In a traditional IRA, taxes are deferred until retirement, often at a lower rate. In a Roth IRA, gains are completely tax-free forever. Buy at $30, sell at $150, and keep every dollar. There are rules. You can't store the silver at home, and it must be held in an approved depository. This strategy is best for long-term investors, but it's exactly how wealthy investors avoid the 28% collectibles tax altogether. Another powerful option is moving to a no-income tax state. This is drastic, but extremely effective. If you live in a high-tax state like California and plan to sell a large silver position, state taxes alone can cost you 6 figures. Moving to Texas, Florida, or Nevada before selling can eliminate that tax completely, as long as you establish real residency. If you're charitably inclined, donating appreciated silver is another strategy. When you donate silver to a qualified charity, you can deduct the full market value and avoid paying capital gains tax entirely. The charity benefits, you receive a large deduction, and the IRS collects nothing on the gain. You can also harvest losses. If you have losing stocks or investments, selling them in the same tax year as your silver sale can offset gains dollar for dollar. And finally, spreading your silver sales over multiple years won't reduce total tax, but it can prevent massive single-year tax shocks and give you flexibility. Here's the action plan. First, document everything: receipts, invoices, bank statements, and back them up. Second, run the numbers and calculate exactly how much tax you'll owe if you do nothing. Third, consult a tax professional who understands precious metals and self-directed IRAs, not a generic CPA. And finally, Plan your exit with taxes in mind, not as an afterthought. The silver bull market may create massive wealth, but the IRS is waiting to take up to 40% of it. The 28% collectibles tax is real, and it's brutal, but it's not unbeatable. Now you know the trap, and more importantly, you know how to escape it. Stay informed, stay strategic, and don't hand over six figures to the IRS when it was legally avoidable.